Good day, class, and welcome to our ATS3 taxation. We are going to be solving a past question in preparation for your exams. We are looking at a past question based on March 2020 Insight ATS3 Insight, March 2020. Now we are going to be looking at only the calculation parts. Now we'll look at question number 3. Question number 3, International Telecommunication Limited. Now the mention of the word telecommunication makes it special business. Special business. So when you see telecommunication, they are into special business. You see airlines, you see telecommunications, these are special business. Now, that's one thing you will know, that we are dealing with special business. Another thing you will know is that the company is not going to be based in Nigeria, but it may have an office in Nigeria or is servicing Nigeria. So let's look at it now. International Telecommunication Limited is based in Toronto, Canada, but has representative office in Nigeria. It provides telecommunication services between Toronto, Nigeria, and other parts of the world. So because it is not based in Nigeria, it's not a Nigerian company, it's a foreign company that has a branch in Nigeria. So the worldwide income will go to Toronto, whereas the income made in Nigeria will be chargeable to tax in Nigeria. Now, because this is a telecommunication business, it is treated as a special business. Now, it goes on to say that the company's financial result for the year ended 31st December 2019. Of course, when you say this is the basis period, you know that the year of assessment should be 2020. Now, these are as follows. We will need to look at Nigerian income here and the ones that are not Nigerian income. So, all these are incomes from all the places where they serviced. Nigerian income is determined by origin, where the income originate from. Now, this is income from voice, that's voice call, text messages, and data service. Now, this is from Canada to other parts of the world. This is not Nigerian income. Now, this is from Canada to Nigeria. The origin is Canada. Destination is Nigeria. So because the origin is Canada, it is not a Nigerian income. Now, if you look at this, from Nigeria, so that's the origin, from Nigeria to Canada. So this is a Nigerian income. From Nigeria to other parts of the world, another Nigerian income. Then we are told the global expenses include, these are the expenses. The ones that are not allowable is depreciation. Then we also have non-allowable expenses. So these two are not allowable expenses. So you are not going to remove them when you are removing allowable expenses. Now you are asked to determine the tax liability of the company for the relevant year of assessment. Of course, that is the year 2020. How do we solve this? This for 12.5 mark. All right, so let's do it now. The name of the company is International Telecommunication Limited. So we go. This is question number 3. International Telecommunication Telecommunication Limited. And we are looking for the tax liability. for year of assessment 2020. So that's the year of assessment that we are looking at. Now, we'll look at, put 2 naira sign here. Put our 2 naira sign here. So we will start with Nigerian income. We need to differentiate Nigerian income from non-Nigerian income. So the Nigerian income here happens to be Nigerian income here happens to be 83,680. Of course, these are 3 zeros, so I'll put them in bracket and sum them. 83,680, is that it? 83,680, yes, and 320,400. 320,400. Now, when you add them together, what do you have? 83,680 plus 320,400. What you get is 404,80. I can put it here, 404,80. So that's Nigerian income. The next is to look for the non-Nigerian income. This is non-Nigerian income. So we can lump them up. We're only interested in identifying Nigerian income. Every other income is non-Nigeria. That is not our business, but we'll need to know them. So this is 720,850, 720,850. We also have 65,70. So we have 65,70. So when we add these two, we will be getting our non-Nigerian income. So let's add them together now. 720, 850 plus 65,070. So that's 785,920. 785,920. So when you add them together, we are going to get your global income. So let's add it to this 404,080. We have 1,190. 1,190. We need to check if that is what they have here. So yes, this is correct. So we've done our income. Now we look at all the expenses. We need to remove allowable expenses. So we'll say less global. Okay, so this is global income. So we'll first of all call this global income. So this is our global income. So less global allowable expenses. So what are these global allowable expenses? We'll look at them. Salaries and wages is 80,000. So we'll start. Salaries and wages. Put them here. 80,000. The next one, so that means I'm done with this. The next one is administrative expenses, 95,200. admin expenses 95,200. What else? Then we have rent 25,000. Rent rent is 25,000. Now the rest of these that will mark bad here are not allowable expenses. So what do? We only take this allowable expense. When we add them up, what do we have? Let's add them up. We say 80,000 plus 95, 200 plus 25,000. That gives me 200, 200. All right, so I'll take it down here. I'll put it in bracket 200, 200. So that's my global expenses. So I'm going to remove this from this here, from the global income. So I'll have 1190. So that means I have 989,800. 989,800. 989,800. What do we call this? This is your global profit. So don't mix it up. Global income is revenue globally. Global profit is what is left after you've taken away your allowable expenses. Now, this is your global profit. After getting this global profit, what do? You are going to do something called ratios. We are going to do something called ratios. The first ratio is adjusted profit ratio, which I call APR. Now, your APR is simply your global profit, because it's adjusted profit ratio, all over global income times 100%. So what do we have here? We have 989,800 divided by 1190,000. 1190,000 multiplied by 100%. So leave our answer in percentage. So this is 989,800 divided by 1190,000 times 100. So this is 83.18. 83.18. 83.18%. So your profit is 83%, 83.18% of your income. So that's for that. The next one is called depreciation ratio. Depreciation ratio. That's the second ratio you are going to do. I call it DR. Your depreciation ratio is your depreciation, which is global, of course. Global depreciation. Let me write it. Let me write that well. So it's going to be global depreciation all over global income times 100%. Now your depreciation, which is a non-allowable expense, is what we use here. We are using it in place of capital allowance because Capital allowance is not given here. 61,880. 61,880. So we have it here as 61,880 divided by 1,190,000, now multiplied by 100%. So we'll do it again now. 61,880 divided by 1,190,000, right? Multiplied by 100, giving us 5.2% as your depreciation. 5.2%. So that's it. Now that we've gotten our ratios, the next thing now to do, now these are global ratios. What we just did here now is we have ascertained that in the global perspective, this is the profit we got, 989,800. And this is the income we have, 1,190,000. We are now saying that our income, our profit is 83.18% of our income. And we're going to assume that that is how all the income of all the countries that they service, that is how it goes. It flows linearly. So it means that Nigerians' profit will be 83.18% of Nigerian income. Nigerians' capital allowance, which is depreciation, will be 5.2% of Nigerians' income. So that's what we are going to do now. Let's go Nigerian specific. I want to look for Nigerian income. What is Nigerian income we got before? We have it as 404,080. So that is 404,080. After getting Nigerian income, we need to know Nigerian adjusted profit. Nigerian adjusted profit. Now, Nigerian adjusted profit, you see this adjusted profit percent we've just calculated, you multiply it by Nigerian income, 83.18%. So you say 83.18% multiplied by 404,080. So that's it here. So we have 83.18 divided by 100, that's the percentage, times 404,080. And that gives me 336,114. 336,114. All right, that's your adjusted profit. You will now less Nigerian depreciation. Depreciation, we calculated it in DRO ratio to be 5.2%. So we'll take 5.2% of Nigerian income. So this is going to be 5.2% of 404,080. So that's it. 5.2 divided by 100 times 404,080. And that gives us 21,012. 21,012. 21,012. So when you less this, so we'll now do it 336 114 minus 21,012. So that will give me 315,102. 315,102. Now that will give me your taxable profit. So this is your taxable profit that you'll be charging to Nigerian tax. So you will say CIT at 30% of 315,102. So let's look for 30% of this multiplied by 0.3. That gives me 94,531. 94,531. So this is your CIT. Then you will need to check minimum tax. Minimum tax is 2% of your Nigerian income, which is 404,080. So minimum tax is 2%, right? Which is 0.02 times 404,080. That gives me 8,082. 8,082. So of course, this CIT is bigger than the minimum tax, so your tax liability is 94,531. And that's the answer to the first question. So that's how this is being solved. So that's the answer to our 12.5 mark question. We now move to the second part of the second question, which is question number 4. We are told that Stefano Grid Nigeria Limited has for many years prepared accounts to 31st December, but in 2017, that is what they mean is by year of assessment 2017, the company decides to prepare a 16-month account to 31st April. So it means that in 2017, there is an account that ends in 30th April. Okay, so what it means is that they prepared a 16 months, so 12 months plus 4, 16. So it means that 2017 has 2017 year of assessment is the year that the company made a change. So what happened here is that 2016 okay, so what happened here is in 2017, instead of bringing their account from January to December, they extend it to April 2016. So it means this must have started counting from January 2015 to April 2016. Okay, so that is where this account would have been started. So the company decides to prepare these 16 months. The adjusted profits are as follows. And now we are told to prepare assessable profit for relevant years. So this is a change of accounting date. So this is 2019. So this should be 2020 year of assessment. This is 2019, 2018, 2017. So what happened here is 2016 year of assessment is missing. So we are going to start from 2016 year of assessment. No, okay, we are going to start from 2017 year of assessment. So what happened now is we are going to look at this question by, okay, let's look at this question now. The name of this company is Stefano Grid Nigeria Limited. This is question number 4. Question number 4. Stefano Grid Nigeria Limited. So we have the company is doing for accessible profits. So I would say accessible profit for years of assessment 2017 to 2019. Okay, 2017 to 2019, which is a 3 years. So for change of accounting date, the first year of change, okay, the first year of change, that's the first assessed relevant year. Then this 2 years after it will be also considered. So I will come here and say, based on old account date, and I will say new account date. So I want to see which of them. So the base on the old account date here, this is um, December 31. This is April 30. So we have years of assessment 2017, year of assessment 2018, then year of assessment 2019. Then we will do something as sum of accessible profits. So we are going to be summing these 3 things we've gotten here. We are going to sum them. We're going to also sum this. So whichever gives us the higher one is what we are going to take. So these are workings. So this is going to be workings 1, workings 2, and workings 3. So we'll go straight to our workings. So this is our workings. Now let's use the next page here for workings. Workings. Workings number 1, years of assessment 2017. And I would say for old account date, basis period is January 1, 2016 to 31st December 2016. Now, which account has January 1 to December 2016? It is 360,000. So you just say this is 360,000. Take it straight down here. This is 360,000. Now for the new accounting date, for new accounting date, so the basis period will be May to April. 1st of May 2015 to 30th April 2016. Okay, so what would that be? Where will we get 1st of April? 1st of May rather. 1st of May 2015 will be in this first place. So from May to December is going to be 8 months. So we're going to take 8 months period here. Okay, we're going to take 8 months from 270. So this is going to be 8 over 12 of 270,000. Then the remaining 4 months, we are going to take it from this 360. We're going to take it from this 360. 4 over 12 times 360. Okay, so this is 8 divided by 12 times 270. That gives me 180 here. So this is 180 plus 4 divided by 12, okay, times 360. That gives me 120. 120 plus 180 give me 300. So this is what is here. So this is 300 for new accounting date. So this is 300. All right. For year of assessment 2018. So that's workings 2. Year of assessment 2018 for old account date. Old account date, the basis period is January 1, 2017 down to 31st December 2017. So we call it preceding year basis. This is 2018, it must end in 2017. So which account do we know that ends in 2017 here? There is no one here ending in 2017. The one that has 2017 is inside these 16 months. So it started from January 1, 2017 and ends in April 2018. Okay, so now this is it, 504. So we are going to take 12 months out of that 504. So it's going to be 12 over 16 times 504,000. So what does that give us? 12 divided by 16 times 504,000. That gives us 378. So it gives us 378,000. Then you take it straight down here. That will give you 378,000. Then you do for the new accounting date. So this is for new accounting date. That will give you from May 1, 2016 to 30th April 2017. So where can we find May 1, 2016? We'll find it here. So we are going to take 8 months here. So we are going to say 8 over 12 times 360 plus the remaining 4 months. We are taking it from that 16 months. 4 over 16 times 504. That's why we are going to be getting January to May 2017. It's from here. So what do we do? 8 divided by 12 times 360, that gives me 240. So this is already 240,000. Then 4 over 16, 4 divided by 16 times 504,000. That gives me 126. So this is 126,000. If I add these two together, 126 plus 240 plus 240,000, that gives me 366. So this is 366,000. And I'll take it down here, 366,000. Then I'll do the last one, 2019. So workings 3, year of assessment 2019 for old account date. That's from January 1, 2018 to 31st December 2018. So we are going to see where we get January 1, 2018 to 31st December 2018. So January 1, 2018 is inside here. We are going to take January to April. So we're going to take the first 4 months here, then the remaining 8 months from the next one. So we're going to take 4 over 16 times 504,000. Okay, so that's what we did here before. We get 126, which is 126,000. Then we are going to say plus 8 over 12 times this last one, 216 times 216. So 8 divided by 12 times 216. That gives me 144. So this is 144,000. If I add it to 126 plus 126,000, that gives me 270. So that gives me 270,000. I will now take it down here, 270,000, 270,000, and I'll quickly just add this one up because I have the figures here. 270 plus 378,000 plus 360,000. That will give me 1,000,008. 1,008,000. That is the sum of the three. Then I will do for the new date. For new account date, new account date is May 1, 2017 to 30th April 2018. So where can we find May 1, 2017 to 30th April 2018? We're going to take 12 months out of these 18 months. That's just it. So this is going to be 12 over 18 times 504,000. We've calculated that before. That gives me 12 over 16, 504. Sorry, 12 over 16 times 504. That gives me 378, which is what you are going to take here. 378,000. So we are going to use 378,000 here. So what do? We'll now add these three together. So 300,000 plus 366,000 plus 378,000. It gives me 1044. 1044. Now, comparing these two sum, which one of them gives you the greater one? So it means that this is the higher one. So this will be accepted or used. So the relevant taxable profits are those of, okay, the relevant assessable profit, not taxable profit. Assessable profit, assessable profit are those of the new accounting date, since the sum of the 3 years produce a higher profit and returns and tax. So that's it. That's how this question is going to be solved. So we've solved two questions here, question number 3 and question number 4. In the next video, we are going to be looking at question number 5 and question number 6 of this same year. So keep a date with the next video, as it will be coming to you soon. Thank you.